If you could add one ingredient to your portfolio that might cushion shocks, hedge inflation, and still be traded with a few taps, would you use it? That's what precious metals ETFs offer, and in the next few minutes, you'll learn exactly how they work, how to pick a good one, and the simple steps to avoid expensive mistakes. Stick with me to the end for a quick, repeatable checklist and a 60-second action plan you can use today. First, let's make this simple. An ETF is like a transparent basket you can buy on the stock market. A precious metals ETF is a basket tied to metals like gold, silver, platinum, or palladium. You're not buying bars and stuffing them under your bed. You're buying shares that track the value of the metal or of the companies that mine it, all inside your regular brokerage account. Here's the big picture of how it runs behind the scenes. Think of three roles. The sponsor designs the fund and keeps it running. Market makers are like shopkeepers, constantly posting buy and sell prices so you can trade throughout the day. Authorized participants are the heavy lifters. They can swap big bundles of the underlying assets for new shares of the ETF, or do the reverse. That creation and redemption mechanism helps the share price stay close to the value of what the fund holds. If shares drift too high, big players deliver metal or contracts, create more shares, and sell them down. If shares go too low, they buy shares, redeem them for the underlying, and close the gap. You don't need to do any of that. You just buy or sell like a stock. There are two main flavors, and they behave very differently. Commodity ETFs aim to mirror the price of a metal. Some hold the metal itself in a vault, like bars of gold or silver. Others use futures contracts, which are financial agreements tied to the metal's price. Physical funds are straightforward. If gold is up 1%, the fund should be very close to that, minus fees. Futures-based funds can track well too, but the way futures roll from one contract to the next can add small gains or losses over time. Mining ETFs are different. Instead of owning metal, they own a basket of companies that explore, dig, and refine it. Miners can move more than the metal during booms, but they also bring company risks like strikes, cost overruns, or political disruptions where mines operate. If you want direct metal exposure, look at physical or futures-based funds. If you want potential torque with business risk, miners might fit. Why bother with any of this? Diversification and convenience. Metals often zig when other assets zag. They can provide a psychological and financial anchor during inflation scares, currency wobbles, or geopolitical shocks. And they're liquid. You can place a trade at market open and be out by lunch using limit orders, stop losses, or dollar cost averaging, all without arranging vaults, insurance, or shipping. But there are trade-offs. Prices can swing hard, especially in silver, platinum, and palladium. Futures funds can be nudged by the cost of rolling contracts. Miners can underperform the metal if costs rise or projects fail. There's also tracking error to watch. That's the small difference between the fund and what it's supposed to follow. Add fees and trading spreads, and you'll see that two funds aiming at the same metal can deliver noticeably different results over a few years. Let's talk about cost, because it matters. An expense ratio might look tiny, but it's paid every year. A difference of a few tenths of a percent compounds. Liquidity matters too. Higher average trading volume usually means tighter bid-ask spreads, which is just a fancy way of saying you lose less when you enter and exit. If you're choosing between two similar funds, a lower fee and tighter spreads are your easy wins. Structure matters. For physical funds, look at where the metal is stored, who the custodian is, and whether the bars are fully allocated in the fund's name. For futures funds, look at which contracts they use and how often they roll. For miners, check whether the fund focuses on large, established producers or includes smaller, more speculative explorers. The first will usually be steadier, the second can be thrilling but bumpy. Here's a quick metaphor to make it stick. Imagine 3 ways to get orange flavor. Buying physical metal is like squeezing fresh oranges, direct and pure, but you rely on the fruit itself. Futures are like concentrated juice, efficient, shelf-stable, but the recipe matters. Miners are like owning the orchard. When the harvest is good and prices are strong, profits can surge. When weather or workers strike, yields drop. Taxes deserve a mention. The way these funds are taxed can differ from stock ETFs, and it can vary by country. In some places, funds that hold the metal can be treated differently than stock funds. The point isn't to memorize rules, it's to check your local treatment and, if in doubt, ask a tax professional before you allocate a big chunk.
Now, how do you pick? Start with your goal. If you want a simple inflation hedge and a smoother ride, a low-cost, physically backed gold fund is a common choice. If you want more punch and can tolerate ups and downs, a diversified mining fund might suit you. If you're targeting specific industrial metals like platinum or palladium, be ready for thinner trading and bigger swings. From there, shortlist 2 or 3 funds per category. Compare expense ratios, check average volume and bid-ask spreads, read the fact sheet to confirm the strategy and the benchmark. Look at historical tracking versus the metal or the index, not for performance chasing, but to see how tightly it follows. Position sizing is where most people trip. Metals are a seasoning, not the entire dish. For many long-term investors, a small allocation, say 2 to 10% of a diversified portfolio, can deliver most of the diversification benefit without turning the portfolio into a roller coaster. Decide your target weight up front. Rebalance on a schedule, like quarterly or semi-annually, instead of reacting to headlines. If prices rip higher and your metal slice balloons, trim it back. If it sinks and your thesis hasn't changed, top it up calmly. Let's make it concrete with 2 quick examples. Maya is saving for a home and wants a partial hedge against inflation for the next 5 years without babysitting trades. She chooses a low-fee, physically backed gold ETF, builds a 5% allocation across a few months using dollar-cost averaging, and sets a calendar reminder to rebalance twice a year. John is a growth-oriented investor with a longer horizon who doesn't mind volatility. He adds a miners ETF alongside a smaller slice of a silver fund to diversify his equity risk, limits the total metal-related exposure to under 10%, and sets a stop-loss discipline to keep single-day emotions from running the show. Risk controls are your friend. Use limit orders when you enter to avoid paying up in a fast market. Consider staggered purchases rather than dropping a lump sum on a single day. Keep notes on why you bought the fund: direct metal exposure, portfolio ballast, or tactical trade. If the reason changes, your position should change too. All right, here's your fast checklist. First, define your why: hedge, ballast, or tactical. Second, choose your flavor: physical metal, futures-based, miners, or multi-metal. Third, shortlist 2 or 3 funds and compare expense ratios, trading volume, and historical tracking. Fourth, confirm structure details like custody for physical, roll strategy for futures, or company mix for miners. Fifth, set a position size that fits your risk tolerance and decide your rebalance rule now, not later. Sixth, place your trade with a limit order and record your thesis in 1 sentence. Seventh, schedule a review date and ignore the noise in between. And here's the 60-second action plan. Right after this video, write down your goal for metals in 1 line. Pick your flavor in 1 line. Open your broker app and favorite 3 candidate funds. Check their fees and average volume. Choose one that meets your goal with the lowest friction. Set a calendar reminder for your next rebalance. You're done. Just a heads up, nothing in this video is financial advice. It's all for information only. Explore more tips on money and investing at Money Nova's website.